For insight, let's go to our featured guest of the morning. He's Lyle Stein, president of Forvest Global Wealth Management. First of all, thank you, Lyle, for joining us today.
Morning, Paul.
So a real theme of these markets lately is central banks pushing back against the notion that interest rate cuts are right around the corner from central banks. And yesterday we got inflation data in Canada that really did the same thing. It was a reminder that the fight against inflation is not an easy or even one. We saw inflation tick up from November levels on a core basis, and it was ahead of expectations as well. And indeed, markets have adjusted their forecast for a Bank of Canada rate cut more to June, perhaps, than to April. What is your take on central banks and when rate cuts will come? And are markets overpriced?
Well, I think the issue, I mean, there's a whole bunch of stuff in there, but let's take it one at a time. So the inflation expectations have come down, right? We're at 9% a year ago or so. Now we're down into the 3s and 4s. But, you know, it's been said that it's the last few points that are going to be the toughest to squeeze out. And I think that's what we're seeing. You look at the number in Canada yesterday, it's pretty evident that's what we're seeing. We've had wage increases in Canada well above this 3% level. And so to get below 3% when your wage growth is over 4 is a difficult task. So I think that's what's shaking out, and that's what's got central banks trying to talk down market expectations. You know, markets tend to, I guess, overstate, or they jump quickly when a trend is a perception of change is occurring. So we saw that. And the notion that there'll be 6 or 7 rate cuts is now being questioned. And then the timing, you know, the hope was that the Fed would start cutting in sort of the end of the first quarter, March-April period. Maybe that's going to get pushed back. So those expectations of lower rates meant stocks could go higher. They went higher in that period between the end of October and December. And now they're kind of checking in and saying, well, maybe we overdid it. Maybe we got a little overly enthusiastic because there's a lot of things going on that just aren't the trend to decline.
How material is it if the first cut from the Fed comes in the second half of 2024 as opposed to the first half of 2024?
I think that would damage expectations. I think what we're seeing, and you're seeing it in the long bond market, in particular, rates now coming back over 4%, is that there is a level of interest rates, a cost of money, that does hinder capital markets. And so if the 3.5 is kind of the expectation at the end of 2024, doesn't start happening until the second half, people are going to take second thoughts, particularly if the economy doesn't produce the earnings that people are looking for.
In some of your notes that you provided, you said that some of your portfolio choices have been buying out washed out stocks lately. Tell us why.
Well, we went through tax loss selling, and it was a tough year in the tax loss selling world last year. So there were some, I think, bargains, some opportunities that showed up. But as we look at the world going forward, we have to ask ourselves, what is the long-term return on stocks? And what's the best way to get it? Are you going to get it through growth, or are you going to get it through the bird in the hand, through dividend or share buyback? Cash flow is important. And so I think it's a time when stock picking will become more important because the easy macro trends are now behind us.
You bought shares of TC Energy, or TRAP as it's often called, TRP. Why so?
Well, basically, our view is that the long-term return on equities is going to be around 7-8%. I'm getting 7-8% in a dividend. TRAP has gone through some question marks with respect to its growth. They seem to be telling it well, and that gives us some growth opportunity on top of a dividend where we think the payout ratio is secure. And so when you look at it, you know, you get 7% without taking a lot of risk. That's not a bad place.
And if we just go back to a one-year view of TC Energy, you'll see that the stock has rallied significantly since late October. That's just when the market at large became confident in this idea of declining interest rates ahead. Do you see the shares of dividend payers rallying this year?
Well, they have already, right? Everything's kind of up 15-20%. The question is, which ones of those offer the best growth opportunities in a world where you're looking for 5% plus type kind of yields?
You've also bought, I gather, exposure, I guess ETF exposure to the equal weight S&P 500, a significantly different type of exposure than buying the S&P 500 at large.
Yeah, basically it's the Magnificent Seven versus the not so magnificent 493. And you know, when you look at what the market has done, it is, particularly since that October rally, it was the big cap, the Mag 7, that led the way. But their valuation levels, compared to the rest of the market, look stretched. So if there is economic growth, as everybody has been calling for, the lower PE stocks, the traditional companies that make up these not so exciting 493 should probably do quite well relative to the Mag 7. So when we, look at, we want market exposure, you don't want to fight the Fed when they're cutting. We're looking at how do we get that, and we thought, well, the best way to play it is not chasing the same names that everybody is chasing, but look at the areas where there is value, because if there is economic growth, those guys will do quite well.